Well, folks, we need to talk about something that I think is a really significant development, and honestly, it's not getting nearly the attention it deserves in the mainstream financial media. Denmark's largest pension fund, ATP, which manages about $150 billion in assets, has just announced that they're reducing their exposure to U.S. investments. Now, I know what you might be thinking. Okay, so what? A pension fund is rebalancing. That happens all the time. But I'm telling you, when you dig into the details and the timing of this move, it raises some pretty serious questions about what major institutional investors are seeing in the U.S. financial landscape right now. So let me start by giving you the specifics here because the numbers matter. ATP is not some small regional fund. We're talking about $150 billion under management. That's real money, and these are sophisticated investors who have access to economic data and analysis that most of us can only dream about. They've announced they're cutting their U.S. equity exposure, they're reducing their holdings in U.S. corporate bonds, and they're specifically citing concerns about fiscal sustainability and dollar strength going forward. I mean, let me tell you, that's pretty remarkable when you think about it. Now, before we go any further, I want to mention that if you're watching this and thinking about how to position your own portfolio in light of these macro developments, one of the smartest moves you can make is to allocate some portion to physical precious metals. That's where Summit Metals comes in. These guys have been my go-to for years when it comes to buying and selling physical silver and gold. They understand that what we're seeing with major institutional moves like this Danish pension fund is exactly why having hard assets makes sense. Whether you're just starting to stack or you're a seasoned investor looking to add to your positions, Summit Metals has competitive pricing and excellent service. I'll have their link in the description below. Getting back to ATP's decision, I think we need to look at this in the broader context of what's been happening with international capital flows. Over the past year or so, we've seen some interesting patterns emerge. Foreign holders of U.S. Treasury securities have been net sellers. China has been reducing their holdings, Japan has been less aggressive in buying new issuance, and now we've got European pension funds starting to vocalize concerns about U.S. fiscal policy. These aren't random events, folks. There's a pattern here, and I believe it's telling us something important about the changing perception of U.S. assets globally. Let me give you some specific numbers to put this in perspective. As of the most recent data, foreign holders of U.S. Treasuries own about $7.6 trillion worth of our debt. That's down from highs we saw a couple of years ago. Now, that might not sound like a massive shift percentage-wise, but when you're talking about trillions of dollars, even small percentage changes represent enormous flows of capital. And what ATP is signaling with their announcement is that they see risks in the U.S. that they believe aren't being adequately compensated for by the returns they're getting. Here's where this connects to precious metals, and this is crucial. When major institutional investors start questioning the long-term stability of U.S. fiscal policy and dollar strength, where do you think capital ultimately flows? Historically, we've seen moves into alternative assets, into commodities, and yes, into gold and silver. Now, I'm not saying ATP is necessarily buying huge quantities of physical gold, though it would be fascinating to know their precious metals allocation. What I am saying is that the concerns they're expressing are exactly the kind of macro environment where precious metals tend to shine. I've been thinking about this a lot, and a viewer of mine actually sent me a message yesterday pointing out something interesting. They noted that European institutions have been ahead of the curve on several major financial shifts over the past decade. They were early in flagging concerns about subprime mortgages before the 2008 crisis. They were among the first to seriously question negative interest rate policies. So when a major European pension fund starts publicly reducing U.S. exposure, I think we need to pay attention to what they're seeing. Now let's talk about what ATP specifically cited in their announcement. They mentioned concerns about the U.S. fiscal deficit, which is running at nearly $2 trillion annually. They talked about the debt to GDP ratio, which is now well over 100% and climbing. They expressed uncertainty about the political environment and its impact on economic policy. These are the same fundamental concerns that many of us in the precious metals community have been talking about for years, but now we're seeing it validated by a massive institutional player. The timing of this is also pretty wild when you think about it. We're in an environment where interest rates are elevated, which you'd think would make dollar-denominated assets more attractive because of the yield. But ATP is looking past the short-term yield and asking deeper questions about the sustainability of the whole system. Can the U.S. continue to service its debt at these interest rate levels? What happens when that debt needs to be rolled over at even higher rates? These are legitimate questions that don't have easy answers. I want to give you some additional context about what's happening in the Treasury market because I think it's relevant here. We've been seeing some unusual patterns in Treasury auctions lately. Some auctions have been coming in with higher than expected yields, which suggests that demand isn't as strong as it used to be. The Federal Reserve has stepped back from being the buyer of last resort like they were during the pandemic. So now the Treasury has to find real buyers in the private market. And if foreign pension funds like ATP are pulling back, that creates a gap that needs to be filled somehow. This brings me to a point about monetary policy and its intersection with precious metals. The Fed is in a really tough spot right now. They've got inflation that's proven stickier than they wanted, they've got an economy that's showing mixed signals, and they've got a government that's running massive deficits that need to be financed. If foreign buyers continue to step back, the Fed may ultimately have to step back in to support the Treasury market, which means more money creation, which is fundamentally bullish for gold and silver over the long term. Now, I know some people will argue that ATP's move is just portfolio diversification, that it's not a comment on US fundamentals per se. And look, maybe that's part of it. Prudent portfolio management does require diversification, and maybe they were overweight US assets and are simply rebalancing. But I'll tell you what, when I read their actual statements and the rationale they provided, it sure sounds like they're making a call on US fiscal sustainability, not just routine rebalancing. Let me throw out some numbers on what we're seeing in the precious metals markets right now, because I think it's relevant to this broader discussion. Gold is trading around, let's call it $2,600 an ounce as of this recording. Silver is in the $30 range. These prices have held up remarkably well despite headwinds from higher interest rates and a relatively strong dollar. That tells me there's underlying demand that's supporting these levels, and I believe institutional concerns about fiscal sustainability are part of what's driving that demand. I've also been watching the premium situation in physical silver, and it's fascinating. Despite paper prices being relatively stable, we're seeing persistent premiums at dealers. You go to buy physical silver rounds or bars, and you're paying anywhere from $3 to $5 over spot, sometimes more depending on the product. That spread between paper and physical tells you something about real-world demand versus what the futures market is pricing in. When major institutions start questioning U.S. fiscal policy, I think individual investors should be paying attention and considering their own allocation to hard assets. Here's something else that I find pretty interesting. Denmark as a country has historically been quite conservative in its fiscal management. They run relatively balanced budgets, they have a strong social safety net, but they pay for it with taxes. They don't rely on massive deficit spending like the U.S. does. So when a Danish pension fund looks at U.S. fiscal policy, they're coming from a perspective of fiscal discipline, and what they see probably looks pretty concerning to them. The U.S. is running deficits in good times and bad, adding trillions to the debt regardless of economic conditions, and there's no clear path to fiscal consolidation. I want to address something that I'm sure some viewers are thinking. But the U.S. dollar is the world's reserve currency. Doesn't that give us special privileges? Can't we run larger deficits than other countries? And yes, reserve currency status does provide some advantages. It means there's structural demand for dollars and dollar-denominated assets. But here's the thing, and this is important. Reserve currency status isn't guaranteed forever. Throughout history, we've seen reserve currencies change. The British pound was the dominant reserve currency before the dollar. These things can shift, and they often shift slowly at first and then very quickly. What ATP's announcement might be signaling, and I'm speculating here, but I think it's informed speculation, is that we're in the early stages of a gradual diversification away from dollar dominance. Not an overnight collapse, not some catastrophic event, but a slow rebalancing where the dollar becomes less dominant, and other currencies, other assets, play a bigger role in global finance. In that kind of environment, gold and silver become increasingly important as neutral reserve assets that don't have the political and fiscal baggage of any single country. Let me give you another angle on this. I was reading some analysis from a well-known macro investor, and he made the point that when foreign holders of U.S. assets start to pull back, it often precedes changes in dollar strength. The logic is straightforward. If there's less foreign demand for U.S. assets, there's less demand for dollars to buy those assets, which can weaken the dollar. A weaker dollar, all else being equal, is generally positive for dollar-denominated commodities like gold and silver. Now, we haven't seen a major dollar weakness yet, but these are the kinds of flows that develop over months and years, not days and weeks. I also think it's worth considering what this means for the average investor, which is probably you watching this video. If a $150 billion pension fund with teams of PhDs and sophisticated risk models is concerned about U.S. fiscal sustainability, should individual investors be thinking about these same issues? I mean, we don't have the same resources they do, but we can observe what they're doing and draw our own conclusions. And what they're doing is reducing exposure to U.S. assets because they see risk that they believe isn't adequately priced in. Now, I'm not sitting here telling you to sell all your U.S. stocks or bonds. That would be ridiculous and irresponsible. What I am saying is that diversification makes sense, and that includes having some allocation to assets that perform well when there are concerns about fiscal sustainability and currency strength. Precious metals have historically been that hedge, and I believe they continue to serve that function today. Let me share what I'm doing personally because I think it's relevant. I continue to dollar cost average into physical silver and gold. Every month, I allocate a portion of my savings to adding to my stack. I don't try to time the market. I don't wait for the perfect price. I just consistently accumulate. When I see news like this ATP announcement, it reinforces my conviction in that strategy. These are the kinds of macro developments that support the long-term case for precious metals, even if they don't cause immediate price spikes. Here's another thing to consider: the velocity of these changes. Right now, ATP's announcement is relatively quiet, not making huge headlines outside of financial media. But what happens if other major European pension funds follow suit? What if we start seeing pension funds in Asia making similar announcements? There could be a cascade effect where the move by one major institution gives cover for others to do the same thing. And if that happens, the impact on U.S. asset markets could be significant. I've been thinking about the industrial demand side of silver as well, because it's not just about investment demand and macro concerns. Silver is crucial for solar panels, for electronics, for electric vehicles. If we see economic uncertainty leading to more government stimulus and green energy initiatives, that could drive industrial demand for silver even higher. So you've got this interesting dynamic where the same fiscal concerns that are driving investment demand could also lead to policies that increase industrial consumption. That's a pretty compelling setup from a fundamental standpoint. Let me also touch on what this means for the banking sector, because I think there are some interesting implications there. U.S. banks hold a lot of treasuries on their balance sheets. If we see yields rise because of reduced foreign demand, the value of those existing treasury holdings goes down, which creates unrealized losses for banks. We saw hints of this stress last year with some regional bank issues. If the trend of foreign selling continues, it could create ongoing pressure in the banking system, which circles back to why having hard assets outside the banking system makes sense. Now, I want to be balanced here and present the other side. There are analysts who would argue that ATP's move is being overinterpreted, that it's routine portfolio management, that the U.S. economy and dollar are still fundamentally strong. They point to the fact that the U.S. is still growing, that innovation continues, that we have deep and liquid capital markets that are the envy of the world. These are fair points, and I'm not going to dismiss them. The U.S. has tremendous strengths and advantages. But here's my counterpoint. You can acknowledge U.S. strengths while still recognizing that current fiscal policy is unsustainable. Both things can be true simultaneously. The U.S. can have a dynamic economy and innovative companies while also running deficits that are concerning from a long-term perspective. And what matters for investors is how you position yourself given those realities. I also want to talk about gold for a moment, because while I focus a lot on silver, gold is obviously a key part of this discussion. Central banks globally have been net buyers of gold for years now. They've been diversifying their reserves away from pure dollar holdings into gold. That's a form of de-dollarization that's been happening quietly in the background. ATP's move fits into that broader pattern. It's not just about selling U.S. assets. It's about recognizing that the dollar-centric global financial system may be evolving into something more multipolar. Let me give you some thoughts on what to watch for going forward. First, I'll be monitoring whether other major European pension funds make similar announcements. Second, I'll be watching foreign holdings of U.S. Treasuries to see if the selling trend accelerates. Third, I'll be paying attention to Treasury auction results to see if demand continues to weaken. And fourth, I'll be watching precious metals prices and premiums to see if institutional flows start showing up in those markets. There's also a geopolitical element to all of this that I think is worth mentioning. We're in an environment of increasing multipolarity, where U.S. geopolitical dominance isn't as assured as it was 20 or 30 years ago. When you combine fiscal concerns with geopolitical shifts, it creates an environment where alternative reserve assets become more attractive. That includes gold, it includes silver, it potentially includes other commodities and currencies. We're in a transitional period, and transitions can be volatile, but they also create opportunities. I want to emphasize again that I'm not predicting doom and gloom or some imminent collapse. What I'm describing is a gradual shift, a slow rebalancing that could play out over years or even decades. But the direction of travel matters, and I believe ATP's announcement is a signal about that direction. They're looking at U.S. fiscal policy and dollar strength prospects and deciding they want less exposure. That's meaningful, and it should factor into how we think about our own portfolios. For those of you who are new to precious metals investing, let me just say this. The case for having some allocation to gold and silver isn't about predicting the end of the world or betting against America. It's about having balance in your portfolio, about having assets that perform well in different economic environments. If we see continued concerns about fiscal sustainability and dollar strength, precious metals provide a hedge. If we see economic growth and stability, you still have the rest of your portfolio working for you. It's about balance and risk management. I'm going to be watching this ATP situation closely, and will provide updates if we see any follow-through from other institutions. This is the kind of development that doesn't create immediate fireworks, but could be really significant over time. Make sure you're subscribed to the channel so you don't miss those updates, because I think this story has legs and we'll be talking about it more in the coming weeks and months. Let me also address something that I know is on a lot of minds: the relationship between interest rates and precious metals prices. Conventional wisdom says that higher rates are bad for gold and silver because they don't yield anything, so the opportunity cost of holding them goes up. And there's truth to that in normal environments. But what we're seeing now isn't a normal environment. We've got rates that are elevated, sure, but we also have inflation that's still running above target, and we have fiscal deficits that are unprecedented outside of wartime. Here's another way to think about it. If you're ATP and you're looking at US Treasuries yielding, let's say, 4.5%, that looks attractive on the surface. But if you're concerned about the long-term purchasing power of the dollar, if you're worried about fiscal sustainability, suddenly that 4.5% yield doesn't seem as compelling. You're getting paid in dollars that you think might lose value over time. That's where the appeal of hard assets comes in. I've been thinking a lot about historical precedents for what we're seeing. If you go back and look at past periods of reserve currency transition, they're typically messy and they take time. When the British pound was losing its status as the dominant reserve currency in the early 20th century, it wasn't a clean handoff. There were crisis moments, there were periods of stability, but the overall trend was clear. I'm not saying the dollar is doomed, but there are parallels worth considering. I also want to talk about the implications for silver specifically, because while gold gets most of the attention in these macro discussions, I think silver has a really compelling story right now. Silver has this dual nature where it's both a monetary metal and an industrial commodity. So you get the safe haven bid that comes from fiscal concerns and dollar worries, but you also get the industrial demand that comes from electrification, green energy, and technology adoption. That combination is pretty unique, and I believe it sets up silver for potentially outsized moves if these trends continue. Before we wrap up, I want to hear from you in the comments. What do you make of ATP's decision to cut US exposure? Do you think this is the beginning of a broader trend, or is it an isolated case? Are you adjusting your own portfolio in response to these kinds of macro developments? I'm genuinely curious about your thoughts because we've got a really knowledgeable community here, and I learn from your perspectives just as much as I hope you get something from my analysis. As always, I want to remind everyone that what I'm sharing here is my analysis and opinion, not financial advice. You need to do your own research, understand your own risk tolerance, and make decisions that make sense for your specific situation. I'm just here to share what I'm seeing in the markets and how I'm thinking about these developments. The final decisions are always yours to make. Thank you so much for watching. If you found this analysis helpful or thought-provoking, please hit that like button. Share it with anyone you think would benefit from this perspective. And if you haven't already, subscribe to the channel and ring that notification bell. We're living through some really interesting times in the financial markets, and I'll be here to help you navigate them. Until next time, keep stacking, keep learning, and most importantly, stay informed. Take care, everyone.